Joining us is Stephanie Link. She is Chief Investment Strategist and Portfolio Manager at Hightower Advisors. She is also a CNBC contributor. And Stephanie, is there any commonality, any link between these three companies, or is this just each individual company kind of digging through and making a call?
Yeah, I think, Becky, that's the kind of the theme this year. I think it's stock picking, right? It's trying to find opportunities in the market when there are dislocations, right? So you mentioned, the couple of the names that I like. Well, UPS is one of them, and it's actually a fairly recent pick for me. It's down 14% from its highs. It was down 10% just last week alone. After they reported earnings, they definitely disappointed. Numbers definitely came down, but they only came down by about 5%. And I think that the CEO is being conservative, just what's happening around the world, right? And also the U.S. volumes are definitely slowing. But this is a company with $100 billion in sales. So it's got size, it's got scale. And the CEO is doing a great job in terms of technology innovation. And so I think margins have upside. So it's very company specific, but it's blue chip on sale.
Okay, except for Procter & Gamble, I'm wondering, is that because they were able to get such strong pricing power, the margins that they've been able to maintain?
Yeah, I thought pretty much all of the consumer staples companies did really well this past quarter in terms of organic growth. And Procter & Gamble grew organic growth at 7%. They beat on revenues, they beat on earnings, they beat on margins. They actually raised guidance. So I think they're doing a really good job in terms of their marketing prowess. They've got great products, and the consumer is hanging in there. They're still buying their products. So the only problem with P&G is it's a bit expensive at 26 times forward, but I kind of like it as a balance to what I just mentioned with UPS, which is more of a cyclical company.
What about a retailer, TJX? I mean, all we hear lately is that consumers are still willing to spend, but on experiences, not necessarily on stuff.
But there's a ton of inventory in the system, right, and from the department stores, and that actually helps TJ. So I like that part of it. I also like the home side of it, home goods, home sense, especially as you guys were talking earlier, interest rates are coming down, right? And so I think housing is actually going to, I think the mortgage rates are definitely coming down, right? So, and I think housing is really going to stay strong. I mean, look at all the housing stocks and how well they've done year to date. And that's because we've had 13 years of underproduction in the industry, and you have 5 million millennials just entering into the arena of buying a home. And so while I know there are puts and takes in housing, I like the discounting and the off-pricers with regards to the home side of the equation, and TJ is one of the very best.
Steph, you own Starbucks. We were just talking about what a great quarter it was, but the stock is down by about 5% this morning because the company didn't raise any guidance for the rest of the year, despite the big beat that they just saw in this quarter. Do they see something concerning coming? Are they being conservative? What's your guess?
I think they're being conservative. You have a new CEO at the helm, and there are uncertainties out there. But this was an outstanding quarter, Becky. And I think Andrew mentioned it. The stock's up 15% year to date, but it's also up 60% from June of last year. And it does trade at 33 times forward estimate. So it is rather expensive, but you just got a 25% earnings growth year over year. You got a 14% revenue growth year over year. And within the comps, you guys went through the breakdown, and you mentioned China at 3%, but they saw a 30% growth in the month of March. And that's one of the reasons why I really like Starbucks, because I think it is a reopening play in China, and we're just beginning to see that. So I thought they did a pretty good job in terms of outlining the metrics, again, on the conservative side. But I can see a clear path of 17 to 18% operating margins, which is their goal over the next couple of years, which is, I think, what people want to see. Not only the top line, they want to see operating margins as well.